talk for just a little bit about money management, because I know there are a lot of tools out there. There CDs, money market, bonds, bond funds, annuities, real estate, alternative investments, stocks. Stocks are usually, people think of that as the most volatile part, or the top of the asset stack.
Yeah.
In that sense. You're a money manager. You're not at one of the big wirehouses that we named earlier that are sticking people into mutual funds. Are you a stock picker?
No. In fact, I tell clients that's not what I do. If that's what you want, go somewhere else.
Move down the road. Yeah.
I'm in front of clients all day. If you think, anyone that's out there that's got a financial advisor, if they think the person on the other side of the table are doing the investments, right? When they're in meetings all day, how in the world can I be in client meetings all day and watching the markets and managing their money in the market and picking stocks and doing that, right?
Sure.
So I think a huge problem with our industry is advisors need to pick what they want. And there are advisors that clients meet with that are picking the investments and doing that. But they're also in meetings all day.
Right.
How do you do both? There's only so much time in this world, right? It's our most valuable asset.
Even on our regulatory filings, asks how much of your time do you spend during the trading hours? Are you doing what? It asks us that.
Now, even with my own assets, I manage some of my own and pick my own stock myself. I'm sure you do too, right? Yeah. But the bulk of it, do I do that? No. So clients don't come to us to build out some, modern portfolio, 60% equities, 40% bonds, which a lot of wirehouses do. And they charge management fees, and all they do is rebalance quarterly. If that's what you want, move it to Fidelity, TD, Schwab on your own, and don't pay that's not management to me.
That's right.
Right? So the reason clients come to us is we use institutional money managers. For example, Amazon, Apple, Microsoft, Home Depot. Do you think they walk into Ed Jones, Charles Schwab, Merrill Lynch, and say, we got $10 billion to invest, what do you have to sell us? No, they go to institutions that manage their money for their objectives and their risk tolerance, right? And those money managers make changes as the economy changes, as the market changes, as the risk tolerance of their client changes, right? So I would say 10 to 15 years ago, it was darn near impossible for the average consumer to get to an institutional money manager because these institutions require you to have millions of dollars, right? Yeah. So you know all the different ones we work with. Some of them have $25 million minimums. Now, the difference here is if you want to go in and get sold something and pay a commission up front, there's nothing wrong with that. That's that way to do it. This way to do it is you pay a management fee, right? And the philosophy here is we want our clients' assets to grow as we make more. I darn sure don't want them to lose 50% and my income cut in half. Right? So we're incentivized to try to reduce risk in a down market, right? And preserve their assets and try to grow it in an up market. So really, when we look at these, we use institutional money managers and we try to match our clients. And I normally have 2 to 3 institutional money managers in each client account for different reasons, right? I believe there's 2 main basic reasons of how to manage assets. Strategic, 60-40, 50-50, right? Whatever I'm in, and it rebalances.
And for the layman, strategic is what they're probably most familiar with, what they have in their 401k plan. And it's basically, these are the assets, and I've got some mid caps, some large caps, some small caps, some bonds, international, and that's my allocation. It's going to ride up and down, ride the market up and down.
That's right.
Nothing changes.
Or they don't know what to pick.
Yeah.
So majority pick target date fund that says 2020, 2025, 2030, and you pick the date closest to when you're going to retire, and then it's going to rebalance and do that, and you have no clue what you own inside of there or what it is.
Or I'm sure what my producers are thinking about is Larry's portfolio. Okay, Larry, who's the guy? He's the one guy out of 20 in the department who actually likes this stuff. Seems to know what he's talking about. So now everybody has Larry's portfolio. You know?
Right. So that's strategic. That's one way to do it. And then there's tactical money managers that are forward-looking and either, if equities are selling off, they're backing off. Maybe they're going to bonds. Maybe they're going to gold. Maybe they're going to real estate, right? To try to back off. And then they go in more into equities as they see fit in an improving market. They're not perfect. I'm not saying, that's the way everyone should be. I like a balanced approach. Normally what I've seen over my time of doing this, tactical money managers normally help reduce losses in a down market because they're getting out and switching to different asset classes, but they're slow to get back in.
That's true. Yeah.
They're so slow to get back in. And so on a rebound, strategic normally does better, but in a down, not as good.
Right.
Right?
Yeah, they
So
get killed.
I really like a balanced approach in my client accounts between a tactical money manager with maybe 25 to 40% of the money, then strategic on the rest.